First, this is not investment advice. What's up? I'm Russ. I'm a welder and I have had no financial training. These are my personal opinions based on my active investing since 2018, and my thoughts will probably change as I learn more, but as of this recording, this is honest and accurate. So I just got back from fabulous Las Vegas, and no, I wasn't gambling at the tables. I was at a small meetup with the one and only Ryan Williams and a few community members, including this 24-year-old guy named Ben, who is doing some interesting stuff with his money. And Ben asked me if I were starting all over again today, what would I do differently? But before I get to that, drop a comment below with your answer of what you would do differently as an investor. We really want to hear from you. So the hope is that this is very helpful to other beginning investors. And with that, here's some things I've learned and what I would do differently. Now, my biggest mistake when I started focusing on passive income investing was chasing those high dividend yields. I thought more yield automatically meant more money in my pocket, so I loaded up on stocks like AT&T and Verizon just because they had fat dividends. But the problem is that most super high yields come from companies that have issues. Either the company is really old and has lots of cash lying around that it can't do anything intelligent with, or their stock price crashed, making the yield look high. That's called an accidentally high yield, and it's usually a red flag and not a bonus. Think about it this way. If a stock normally yields 3%, but the price drops 50%, suddenly it looks like it yields 6%. That doesn't mean it's a better company. It means something went wrong and the market is skeptical and you're getting a higher yield for higher risk. And my experience has taught me that the higher the dividend yield, the higher the risk, and the deeper you must look into the stock. When you're young and you have lots of investing years ahead of you, you're in what is called the wealth accumulation phase. You should focus on growing your money and not just getting income right now. There's definitely a time for maximizing dividends, but it doesn't always have to be on day one. So if I were starting from scratch today, here's exactly what I would do. And remember, this is my personal preference and not a recommendation. I would put 85% of my money into a super low-cost index fund, something like VOO or VTI. These funds own hundreds or even thousands of great businesses, and it's like buying a little piece of the entire American economy. And ticker VOO from Vanguard is the S&P 500, which on average grows 10% a year. Some years will be way up and others will be way down, but that is the average. And I think people can lose sight of just how powerful a 10% return consistently compounded over decades can be. And when you buy VOO or VTI, you are basically betting on the entire American economy continuing to grow and innovate. And if it stops doing those things, your brokerage account will be the least of your worries. So I think that covers your base, keeps it simple, and prevents you from blowing up your financial future while you're learning to pick individual stocks, and I think it allows you to sleep easily at night. But what about that other 15%? Well, that's your play money for picking those individual stocks. I mean, I get it. Not everyone wants to be average, and we all think that we can beat the market. And picking your own individual stocks is how you really learn to invest in companies. But keep that small while you're learning. If you follow the channel, you've probably heard me say it a million times, but it's really difficult to beat the market. There was a study called the SPIVA report that looked at professional large cap fund managers over a 20-year period. Remember, these are people with college degrees and professional financial certifications, teams of analysts, and expensive computers managing big company stocks. And guess what? 94 out of every 100 of them failed to beat the S&P 500. I mean, think about that. These are the professionals with every advantage, and they still can't do it. And I caught myself making excuses too, because when my performance lagged the S&P 500, I would say, well, I'm not trying to beat the market. I'm trying to maximize my dividend income. And when I looked at those stocks that I picked specifically for dividend income, on a total return basis, many of them failed to beat the S&P 500. But now I'm a little more honest with myself, and yeah, I still love passive income and looking for dividend growth companies. But isn't it cooler to just have more money? And even the world's greatest investor has thought about this exact question. In Warren Buffett's 2012 annual shareholder letters, and this is a fantastic book, The Essays of Warren Buffett by Larry Cunningham, Warren showed why he doesn't chase dividend stocks, and it completely changed how I think about this. So here's the super simple version of Warren Buffett's exercise. Imagine you and a partner each own half of a $2 million business, and it makes 12% a year, which is $240,000 in profit. You have two choices. The first path is to take dividends. You decide to take 1/3 of the profits as dividends each year. That's $80,000 total. So each of you gets $40,000 in cash. The other 2/3 stay in the business to help it grow. But because you're taking money out, the business only grows at 8% per year instead of the full 12%. And then there's path number 2, which is you sell shares. You take no dividends. All the profits stay in the business, so it grows at the full 12%. But to get your $40,000 in cash each year, you just sell about 3% of your shares. So Warren did the math, and after 10 years, when you follow the dividend path, your half is worth $2.7 million, but when you follow the sell-off path, your shares are worth $2.8 million, about $100,000 more. You have the same $40,000 cash in your pocket each year, but you end up with more total wealth on the sell-off path. That's because those companies are fully reinvesting back into themselves. You pay way less in taxes because dividends get taxed twice, once at the company level and then again when you receive them. Granted, this is just a hypothetical example, and you'd need to find a company making 12% a year in profit, but it's still a powerful lesson as to why Warren looks for great businesses first, because dividends are nice, but they're just the icing on the cake of those great companies. Now, something I've struggled with: when you call yourself a dividend investor like I've done publicly, you can miss some really great opportunities. Fund manager Seth Klarman said it perfectly. Quote, "In investing, it is never wrong to change your mind. It is only wrong to change your mind and do nothing about it." And I felt weird buying Harrow Incorporated, ticker HROW, and my local hometown hero fund stock, Portillo's, ticker PTLO, because they don't pay dividends, and some people even said, "Wait, I thought you were a dividend investor." Guess what? As of this recording, Harrow, ticker HROW, is my third best performing stock, up 115%. So the truth is, you are allowed to evolve and change your mind as new information enters it. Your strategy can actually grow with you. I still love dividend growth investing, but I'm learning to not blind myself to some fantastic potential opportunities because they might not happen to pay a dividend. So if you're just starting out, or even if you've been investing for a while, here's what I would tell you. First, the easy button exists. Use it. Remember, the stock market earns about 10% average annual returns. Some years way more, some years way less. But if you don't want to spend your time reading annual reports, following quarterly earnings, and really studying companies, just hit the easy button, buy low-cost, broad-based index funds like VOO or VTI, which is the total US stock market, and sleep like a baby. There's no shame in this, and Warren Buffett actually says it's the smartest move for most people. Second is to know why the heck you own something. Ben told Ryan and I something in Vegas that really stuck with me. He said he sometimes buys stocks just because he sees other people buying them without knowing anything about the company. It's a huge mistake, and Ben, one that I have made myself several times, because it's super easy to hold a stock that is going up and up and up. But when it drops 10%, 20% or more, and it will, you gotta have conviction. You need to understand what you own and the story of why you bought it. And I've used this with both Agree Realty, ticker ADC, and Harrow Incorporated, ticker HROW, when both dropped significantly after I bought them, but my reason for buying, my thesis was still intact, so I bought more. And without that understanding, I might have panicked and sold at the worst possible time, because over the long run, I've learned some of the stocks that are the best performers in your portfolio also give you the most bumps and bruises along the way. Third is investing versus speculation. Something else I told Ben is that there's a huge difference between speculating and investing. When we speculate, we only care about the stock price. We're just watching numbers go up and down. But when we invest, we think about it differently. And I said, imagine you were going to buy the corner coffee shop in your town. There's no stock price to check every day. So what would you want to know? How much money does it make? Is it growing? Who's running it? Does it have loyal customers? Can it handle competition? Does it have tons of debt? It's the exact same thing with stocks. We're not buying a ticker symbol. I mean, we are, but that ticker symbol is attached to an actual operating company. And when you imagine that there is no stock price to distract you, it forces you to think about that company in a totally different way. Fourth is to not outsource your brain. When you label yourself as part of a tribe, dividend investor, growth investor, Chiefsaholic, you can start outsourcing your thinking to that group, and you might follow what they do without questioning it. After studying Buffett and Munger for many years, I've learned that the market rewards independent thinking and continuous learning. And Charlie Munger even said Warren's secret was simple. He just keeps learning. That's his trick. And I love this saying, live like you'll die tomorrow, but learn like you'll live forever. And 5, mistakes are part of the process. I've made every mistake in the book, and I keep finding new mistakes to make too, but you probably will also make many mistakes. That's okay. It's how we learn, which is why I'm working towards 85% of my investment portfolio in low-cost, broad-based index funds, and 15% to pick individual stocks. And when I feel that I am super solid confident in that, then I might expanding that 15% to 20 or 25 or more. But you get started, you make mistakes, and you get better. Ben, thanks so much for asking me that question in Vegas, and it's really made me think about the ways that I've grown as an investor. And speaking of learning together, I learned from dividend expert Kelly Green about a sector that's been beaten up, but she's very confident and thinks it's going to perform well in the years ahead. So, in this floating little box next to my head, Kelly and I will tell you all about it. So click that floating little box right there, and we will see you over there.